Hey traders, my name is Trent Hoerr from FX, and today we're going to talk about 6 mistakes traders make in choosing a broker. Before we get started, there's just a brief risk disclaimer that you should read. Obviously, trading involves risk, and there's a significant risk of loss of investment, so just keep that in mind. So before we get started, a little bit about me and FX and sort of what we do. So FX helps traders make smarter brokerage decisions, and we really look to help traders find the right broker for their trading style. Unlike on-exchange markets, the Forex industry brings a host of variables due to the OTC or over-the-counter nature. So every broker is going to have different pricing, different execution, different platforms, different regulations, and a host of other variables that don't necessarily apply to on-exchange markets. And we really look to help traders understand those differences and pair them with the broker that makes the most sense for their trading style. So to do this, we take a consultative approach to understand the trader's history, where they're at, their trading style, what they're looking to achieve, any technology that they might use in order to make an educated broker recommendation or two on where we feel they'd be best suited trading. I personally have been doing this for a long time. I've got into the industry as a prop trader in Chicago for a large firm in 2009 before moving on to the Forex brokerage side in 2012 and working for 2 large firms based out of Australia before coming to FX. So then once you have a broker selected, by working with FX, we actually reduce your cost of trading. This through our cashback rebate program. The simplest way to think about us is we act as sort of outside sales consultants to various brokerage firms, well-regulated, well-reputable brokers. Those brokers compensate us on every trade a client makes that we introduce to them. Then of that compensation, we share it back with our clients for being our clients as a value-add incentive, effectively reducing their cost of trading. This is a pure value-add service. It comes at no cost to the trader. The trader is going to receive the exact same spreads, commissions, execution, and all other things by working through us as they otherwise would be had they went to that broker directly. So onto the common mistakes that we see. The first one is a client choosing an unregulated broker. As much as people may not like regulation at time, the regulation is there for your protection. All these rules have been heavily debated and agreed upon, and they're really there for the client's protection. One saying we have here is return of capital is more important than return on capital. And the reason being is we've seen a lot of brokers just unfortunately, for whatever reason, not return client deposits or profits that they've made. And that only really ever happens in unregulated jurisdictions. So the major regulatory jurisdictions such as the NFA in the United States, the FCA out of the UK, ASIC in Australia, this sort of bad behavior doesn't happen. Because there's a lot of capital protections in place to prevent such. Out of the FCA, for example, there's an insurance scheme where every trader is insured up to 50,000 pounds by the government. So should that broker go bankrupt or for whatever reason not be able to return the client's capital, those funds are protected up to 50,000 pounds. In Australia, all clients' funds are held in segregated trust accounts. So when you deposit with the broker, the funds are away from the broker's operating capital and just there to meet your margin requirements with that broker. Believing everything you read would be the second mistake we see. So a lot of times the first thing a new trader does is jump on, once they find a broker, jump on Google and type in broker reviews, and then a host of review websites pop up. But it's important to understand how some of these review websites operate. So many of them operate in the fact that on an advertising budget. So brokers pay them to advertise on their site because they know there's a lot of traders, especially new traders, going there to review their firm. So these websites oftentimes will not allow bad reviews or heavily promote positive reviews and push them to the top, because the broker's not going to continue to pay them if they're not getting good traffic from there. If their review website's flooded with negative reviews about that broker, why would the broker continue to compensate on an advertising deal? Additionally, there's a lot of I guess affiliates that are in this space that have a vested interest in either speaking very positively about a broker or speaking very negatively about another broker. So it's just important to not believe everything you read, but really do your own due diligence. You can do this by checking out the broker for yourself. So even if you come to ForexPark FX, for example, we make a broker recommendation or two, we strongly recommend that you as the trader go and speak with that broker, or ask, if you're in a community, ask George, for example, at TRADEPRO, ask him what he feels about that broker. Go on the broker's website, talk to their live chat, just sort of get understanding. And I do that on my end as well pretty frequently when I'm working with, or when we're working with a new broker. Outside of a few other items, customer service is very important to me, and I just want to know that the broker's there should something go wrong. So, and it's knowledgeable. So I'll go on their live chat and ping them and ask them a couple questions and gauge how fast is the response time, how knowledgeable was the representative once I was able to get through to them. And also I'll do the same thing with either phone calls or emails when we're first starting out. So a good motto is don't follow blindly, think critically. Even if I make you a recommendation on which broker to go with, make sure you just check the broker out before moving forward with them. The third mistake we see is trader not fully understanding price and execution models or regulations. In the Forex industry, you're not trading on exchange, so every broker is going to have a different pricing model and execution model. So starting off, the pricing models, you'll either have an all-in spread or a raw spread plus commission. Generally speaking, the all-in spread is the standard account type at the broker. And what this is the broker receives the spread from their liquidity provider, and then they put a markup on that spread. And that markup is the commission they're collecting per trade. There's no other commissions associated with it. What you're seeing on the platform is the price you're paying. So for example, if you're seeing a 1.2 pip on the euro, probably that's an all-in spread type of model. The next is the raw spread plus commission. Generally speaking, this is the ECN style account is how it's referred to in the retail FX community. And what this means is, instead of putting a markup on the spread, the broker is going to pass you the spreads that they're receiving from their liquidity provider. So if you're seeing like a 0.1 or 0.2, 0.3 on the Euro USD, typically that is going to be the ECN style. But there is an additional cost to that. There's going to be a commission charge. So this can range, but it would range anywhere from $6 to $10 in commission typically. All things being equal, we generally recommend traders go with the raw spread plus commission model because it tends to be a little bit cheaper for all-in costs of trading. The second part of this is dealing desk versus non-dealing desk. Another way you might have heard of it is market maker versus STP, or A book versus B book, and you might not know what these terms mean. Well, the simplest way to think about it is a dealing desk is acting as your counterparty and taking the other side of your trades. And a non-dealing desk is taking your trades and passing them off to another party to fill, so a liquidity provider. There's a lot of negative, I guess, publicity out there about dealing desks. I don't necessarily agree with all of it. I think dealing desks definitely have some value. For example, there are some brokerage firms that their dealing desks have larger depths of liquidity. So if you're a large trader and you're needing to execute a $5 million or $10 million order, generally speaking, a market maker is going to be able to execute that, whereas an STP broker will not be able to because the liquidity that they are showing to the retail traders isn't deep enough, or you're going to receive a lot of slippage on that trade if you do try to trade there. Non-dealing desks, though, typically have a lower cost of trading from my experience, where you're going to be getting very competitive rates. If you're sort of a high frequency trader, then the non-dealing desk might be a good option. So how does regulation change and affect my trading strategy? So the hot topic right now as we're recording this is the new ESMA regulations that came out in Europe that effectively reduced all leverage to 30-to-1 on majors and 20-to-1 on minors. So that could have had a significant impact if your trading required more leverage than that. So it's important to just stay abreast of regulation and know when it's coming out and how it's going to potentially impact you, which is things that we help all of our clients with. The ESMA regulation and that just came out, the MiFID II that came out earlier in the year. These were all things that we knew well in advance of, and we were informing our clients months in advance of how it was going to impact them and sort of what they needed to do to either continue as they are or adjust their trading style. So using a platform for the wrong reasons. Platform is definitely a comfort thing. I personally was not a big fan of MT4 when I first switched over to it. I was coming from the futures world where I traded on TT and used CQG charts. So I always viewed it as a step backwards to go to MT4. But there's a reason why MT4 is the most heavily traded platform in the Forex industry. About 80% or so actually utilize it to execute their trades. There's a lot of reasons, but one of the major reasons is it's very simple to automate trading strategies and manipulate the platform to do what you want. So you can build EAs or custom indicators. All of these things are very easy, and you don't need to be an expert in computer programming to do so. But just because if you're not a EA trader, you're not looking to do that, then it might not be the right platform for you. So it's good, especially as a new trader, just to get out there, test a few platforms. There's MT in the Forex world. There's MT4. There's CTrader. CQG has a platform for Forex trading, and a lot of other brokers have their own proprietary platform. So I would recommend just going out and getting a demo. All Forex brokers have demo accounts. Get a demo account and just sit there and play around with them, see which one feels good for you. If you have any questions, let me or let George know. I'm sure either one of us would be happy to answer them for you. So number 5 is putting a good strategy in a bad environment. A good saying here, we obviously like our sayings, is don't stick a round peg into a square hole. What we mean by that is, depending on your trading style, not every broker is going to be suitable. For example, if you are a high frequency scalper, then execution quality and cost of trading is going to be extremely important. So you don't want to go to a broker or account type that's offering you 2 pip spreads when another broker is out there offering 0.8, 0.9 pip spreads. But on the flip side of that, if you're more of a swing and position style trader, then pricing isn't as important. You just want to make sure that they're pricing stable. So looking at their tick data to see if spreads widen out during news events or rollover is a very important thing. So if you're holding positions for multiple days, you want to go and sort of check to see how that broker spreads handled various news events or the daily rollover, which occurs at 5 p.m. Eastern every day. Did they widen out? Did it widen out significantly enough to where it might trigger a stop loss unexpectedly? Because on all platforms in the Forex world, spreads are included when they're factoring in where your take profit or stop loss is. So it's important to really understand your trading style and pair it with a broker that pairs well with that trading style. We've definitely seen it impact traders. Trading's hard enough. There's no sense in making it more difficult by trading at a brokerage firm that's not properly suited for your particular trading style. And the 6th and final mistake, this is more self-serving, but not using a value-adding introducing broker. Brokers have biases. If you go directly to the broker, that broker, of course, wants your business, and they're going to tell you whatever you need to here to get your account open and approved with them and trading so that they can earn commissions off your trading volume. We at Forex, I think, have done a very good job at having a good representation of all the various style of brokers out there. So whether they're market making or dealing desk or institutional or more retail focused, different regulatory bodies, different platforms, we really went and sought out the best in the various categories that we see out there and have a good representation so we can make an unbiased evaluation when we're advising a client on which broker we feel would best suit them. We're not trying to we're not trying to fit a round peg into a square hole. But yeah, those are basically the 6 mistakes that we see. They're all pretty important to remember, and it's definitely something to consider when opening your account. Life is long. There's no rush to open a brokerage account. You can go, every one of them is going to give you a demo account. You can test out a lot of the features. You can test out their customer support. There's no rushing going live right away. Especially if you're taking this course, you just want to make sure that you finish the course and fully understand, and then move on.